Unveils form your broker may send next year to report your crypto moves. He rule that calls for the new 1990A isn't finished yet, but the U.S. tax agency has shared what the form might look like to report brokered sales of digital assets. The U.S. Internal Revenue Service IRS has previewed what crypto investors' future tax form might look like when it finishes its much-awaited rule on how cryptocurrency transactions should be reported to the federal government. The IRS offered a draft of the 1990A form that would be meant to figure out the taxable gains or losses when brokered digital assets change hands. The form reveals the agency will likely have an array of individual token codes that can be filled in, and it includes spaces for wallet addresses and where to find transactions on the relevant blockchain. Brokers must report proceeds from, and in some cases, basis for digital asset dispositions to you and the IRS on Form 1990A, according to the instructions included with the form, which shows a 2025 date. Who may be required to recognize gain from these dispositions of digital assets. The unveiling is preliminary and may still change depending on the final outcome of the tax rule proposed last year. The establishment of U.S. tax practices for crypto is among the necessary steps toward ridding investors of uncertainty and confusion. Cryptocurrency businesses are nervous about how the IRS will identify the digital asset brokers that would need to comply with the new system, potentially including wallet providers, decentralized platforms, and payment processors. His version of the form asks the filer to check a box that describes the type of broker they are: kiosk operator, digital asset payment processor, hosted wallet provider, unhosted wallet provider, or other. As expected, the look and feel are similar to the Form 1989B for reporting sales of traditional financial products, said Jesselyn Dean, Vice President of Tax Information Reporting at Legible, in an analysis of the form that also noted the IRS has packed a lot of lines and boxes into this form, and pointed out references to so-called wash sales, and that the form provides for transactions that are only recorded internally by crypto firms. He contended that at least one of the boxes on non-deductible losses would need more guidance on how it works. Fuller, the head of government solutions at TaxBit, welcomed the long-awaited draft in a posting on LinkedIn. He form also carries through the requirements in the current draft regulations that wallet addresses and transactions hashes will be provided where relevant. He wrote, his was another point that received heavy feedback for a few different reasons. I am curious if this will change as the final regulations are released.